Welcome back, investors, to Ticker Time News. I'm Adam, and in its latest move to embrace cryptocurrencies, Fidelity Investments is exploring allowing its more than 34.4 million brokerage clients to trade Bitcoin on its brokerage platform. Now, the potential launch, and let me just pull up the chart here for Bitcoin and get it over to the daily view so we can see this price action a little bit better. The potential launch would come after Fidelity already enabled its corporate clients back in April to add Bitcoin to their managed 401k retirement plans. And one more click to make this chart look a little prettier. There we go with Bitcoin. Little flagging pattern there for Bitcoin right this moment. Is that going to lead to a more bullish run? It's back above its 50-day moving average. Or is that going to lead to a bearish fall? Maybe CPI will tell us tomorrow we get that CPI report. Now, back to Fidelity and Bitcoin. If Fidelity does make Bitcoin trading available to its trading platform, then I'd expect competitors to follow right along after them. And if so, that may cause demand for a spot Bitcoin ETF to fall drastically. Remember, back in January, the SEC rejected Fidelity's Bitcoin or Fidelity's spot Bitcoin ETF proposal. So, what did Fidelity do? Fidelity has found a workable solution after its spot Bitcoin ETF failed to get past the SEC. Now, I believe that a regulation of sorts from either the SEC or from Congress would be a good move for the crypto space. If there is some sort of regulation to protect investors that does not inhibit innovation, then I think that would be a win-win, and that would open the door to even more big-time investors, deep-pocket investors, big trusts and big funds and pension funds to all start to invest in Bitcoin. And that is what Bitcoin needs to really get to the next level, right? We're at the next level from the previous level. We are still in the 20,000 to 69,000 range. That was going to the next level. To get above that 69,000 range, to get above that 75,000 price point, we need some sort of regulation that would allow then for the big pension funds, big mutual funds, other ETFs to gain access to Bitcoin, who right now, the legal department of those firms and pension funds and so forth are saying, oh, nope, we're not touching Bitcoin right now. So some sort of regulation that doesn't stop innovation would be helpful. So Fidelity, it's found its workaround. And again, Fidelity Investments, I didn't mention this, but they are a privately owned company. They are not publicly traded. So they have a lot of ETF and they manage capital, but they're not publicly traded. So I just want to get that out there about Fidelity. So with their spot ETF going, nowhere with the SEC, back in January, they opened it up in April to their managed clients, and now they are thinking about putting it on their trading platform. So the 34.4 million plus users that they have can gain access to them. I think that is pretty darn cool. And of course, if they do it, then other big names will as well. All right, next up, I want to touch on Tesla. TSLA is the ticker symbol. And then we'll get into the markets and so forth. We've got CPI tomorrow, so it's going to be a wild day. Tesla up 1.58% today, up a 0.1% in the after hours. But Tesla is looking to potentially build a battery-grade lithium hydroxide refining facility that could support its electric vehicle battery production, which takes place where? In Texas. Tesla is said to be considering potential sites in Texas and Louisiana so they can gain access to the Gulf Coast shipping channel. Tesla is still evaluating the feasibility of the project, but the construction on at least one potential site in Texas could begin as early as the fourth quarter of this year. And with commercial operations up and running by the fourth quarter of 2024. This is very interesting, right? Tesla wants to be, or wants their gigafactories to be, one side of it, all the raw materials go in, and on the other side, their finished products come out of. And everything being highly computerized and roboticized, if that's even a correct term, within their factories. So the price of lithium has exploded in the past year amid a surge in demand for electric vehicle batteries. Since lithium-ion batteries, since lithium is a key component of those batteries. Now, let's jump back to the stock market. Weekly expected move for Tesla this week. I do not have it on the chart, so don't look at those purple lines as an indicator of where it's going. I do not put those up until Wednesday. I want to give our investor community time to have those numbers, to play around with them, and get a path for their strategy this week before I put them on the public live stream. Now, I do have the weekly expected moves for the main indices. So we do have it here, SPX, and you'll see something new here, a couple of additional numbers. The upper end of the weekly expected move for XPX is 41.63. The bottom end is 39.70, okay? Now, I've got two new numbers here. One says on the top in red, 42.60, and then the one in blue on the bottom, 3,900. Excuse me. Why do I have those two numbers? Well, for bulls to say, you know what? We have found the bottom and we are now in a new bull market, baby. They've got to break above 42.60 in order for me to even think about saying, I was wrong, you're right, we're in a bull market. Because I don't think we are in a bull market. I think all we're seeing are bear market bounces. Bear market bounces can be strong. They can rally. They can retrace 50%, sure. But there is a resistance line in 2022 that bulls have not been able to break. And that's this red line here. And make sure my trusty highlighter is out. You can see it set right here at the beginning of this year. It did not break right there. It held. It did not break here and held. So the next point is this circle, the red circle with 42.60. That is this Friday, okay? This Friday, the 16th. If the market rallies strong this week and it gets to that level at 42.60, then that's where the bulls are going to have to fight their hardest to prove that we're in a bull market and we have found the bottom. Otherwise, there will be a rejection at that point, or maybe even lower. Maybe the bulls don't even get that far. But that is, if you are a bull in this market, if you believe with all your heart, if your investment thesis says, yep, we're in a new bull market, then 42.60 is your number, okay? That's your battlefield number right there, okay? That's where you got to hold the ground, hold your ground. Now, if you're a bear, all right, you need to break below this 3,900 level, all right? And that was set back here on this blue trend line that got our June bottom and our July retest. And then, of course, our kind of bounce around here in September. So you got, if you're a bear and you believe like I do, like we have not seen the bottom yet in this market, then 3,900 is the number that you need to break. Okay? It's like you're ice fishing and you're sitting on top of the ice right there at 3,900. You need to kick a hole in that ice, cut a hole in that ice, I should say, so you can stick your line in there and catch some fish. You got to do it at 3,900 and you got to break below that. So those are the two numbers. Write them down, put them on your chart. 4260, bulls have to break it, and 3,900, bears have to break that one. All right. And you obviously know which direction we're talking about here. Bulls to the upside, bears to the downside. Now, with the weekly expected move, it is leaning a little bit more towards the 3,900 than to the 4260, although the weekly expected moves did move up this week compared to last week. So we got a higher high and a higher low this week from last week. But CPI could wreck the whole thing, or it could give the market false hope and send it moving higher. Now, the stock market today, let me clean this up here. And I want to go to the 5-minute chart and look at this real quick because all the action was this morning. Let's see, one more highlighter. All right, so the stock market, it had another strong showing as you move to the 5-minute chart today. And it basically took last week's momentum, carried it over to this week, and continued to build upon that. Now, that's something we said was likely to happen today. Now, the major indices saw another choppy session here right in the middle of your screen between the two volume spikes. That is today in the price action for SPX, for the S&P 500. It was choppy. It bounced around, and it ended with decent gains. The SPX was up 1%. SPY up 1%. Qs up 1.2%. IWM, which are small caps, up 1.2%. So had a good day. Now, all of the gains occurred this morning, pretty much. We gapped up earlier this morning, and we rallied right out of the gate all the way up to the high of the day at about 10:25 a.m. Eastern time. That's when we hit the high of the day, and that was at 41.19. That was today's high. And then we just chopped around from there the rest of the day. Now, it ended pretty peacefully. The chop kind of slowed down as the day went on because more and more investors started to say, okay, I'm going to leave this one alone. We're going into CPI tomorrow. I've made my trades. I am set up. I've maybe removed some profit off the table just in case it doesn't go my way. And I'm set up for whatever happens tomorrow, okay? Because that CPI report, it comes out before the market opens tomorrow in pre-market. So we'll see if that takes place. Now, there was a bit of anxiety in play today ahead of the much anticipated August CPI release. And again, that's at 8:30 a.m. Eastern. The Federal Reserve Bank of New York's macroeconomic data report appears optimistic. Does it? That is interesting. I wonder, I have not seen that report, so I don't know anything about it, but I can Google that and pull that up and see what it talks about. There is some optimistic signs in the market. I just think there's more bearish ones. There's more pessimistic signs right now in the market. But either way, whichever way this market goes, I still believe that by December of this year, I think we're going to know for certain whether we should be feeling positive about this market or negative about this market. So yeah, just keep that in mind. Now, I think there are a lot of chart setups out there that are pretty positive and bullish right now, but we have to be careful with that economic data drops that come out tomorrow, with the Fed next week, what could possibly happen, because those can definitely shake and invalidate those bullish setups that we have so frequently that we are so frequently finding on the charts right now. Let's see here. Back to the market. Buying efforts were also supported by a weakening dollar today. Let's pull up the DXY, which is the dollar. Whenever the dollar has a red day, typically equities have a green day. And the dollar is coming off very fast a high of over 110. This dollar ran up and it has just been going up and up and up. So the past 3 sessions, last Thursday, Friday, and then again today, they have just been bonkers for the dollar, bringing it down. So a weakening dollar helped equities today. If that dollar comes on down, that 50-day moving average is about 107. If it breaks that 107, that will be worrisome, because the 50-day, going back, just recently, right here in June, it held as support. Again, right here in August, the very beginning of August, it held as support. And then here on August the 10th, it slipped under it, but it quickly rebounded and got back above it. So this 50-day moving average, it's always an important moving average, because it's bullish above, bearish below when you think about that 50-day moving average. But you can see here for the dollar, it is definitely a very important turnaround point, a pivot point, where the dollar typically bounces. But this dollar cannot stay, this elevated, 110, 109, I think, for too long, because it puts a lot of pressure on the rest of the world. So dollar weakening today, that was big for the markets. Now, the dollar was down 0.61% today. It closed at 108.35. Pretty decent decline there. Now, it did create, if we scroll in here a little bit closer, let me just open this up some. And I want to go in and look at the candle here for this. If we look at this candle pattern that was left here, we almost, and I need to measure it for sure. Let's see here. From the top to the bottom of that candle is about 0.25. So we should have, from the bottom of the candle to the bottom of the wick, 0.5 for it to really count. It's close. It's not quite there. It's about a 0.46. So a hammer candle, and I'm going to talk about that in just a moment in greater detail. But this is almost shaped like a hammer candle, and hammer candles are reversal candles, okay? So not quite, but it is close to one. Maybe we get closer to that 50-day moving average, and maybe we'll have one appear at that point. Maybe not. Maybe we'll slip through it like we did the last time around, which was, again, August 10th. We closed below it. We stayed below it for about 2 sessions and then popped right back above it. But again, a weak dollar means a strong equity market. Now, the euro to US dollar it rose 0.7% to 1.012. That's basically parity there in my book. Now, Apple, AAPL. Apple had a big showing today. It was up 3.9%. That's a really big move for this mega cap company that has been declining hard. It fulfilled the head and shoulders pattern here. Now, on Friday, it stalled at its 50-day moving average. Well, today, it broke above it, and it just went for the fences. Now, this is not the updated weekly expected move. Again, I don't release those publicly until Wednesday. I keep those in our private investor community. I give them out Sunday evening, and they have all the way through Wednesday evening to have those numbers in advance. So if you would like to get a hold of your own weekly expected moves, just click that first link in the description, and we do it on about 40 products. Okay, Apple, 3.9% today. It showed big upside move today, and it was another supporting factor for the broader market. Now, JP Morgan suggested that the company is seeing strong demand for its new iPhone following last week's product announcements, and they announced a lot of interesting and cool things. So the stock today, and why I want to bring it to your attention, is the 20-day moving average. Apple closed above that today. Okay, so it breaks above and doesn't just move above the 50-day. It gapped up over the 50-day and then broke through its 200-day all in the same day. That is a very strong, fueled with momentum. Volume was above average today. If we look at where volume came in at today, it was about 104.8 million when the average volume is at 71.9 million. So big boost on volume, big gain in a big mega cap stock. So this is definitely going to have an influence on the broader market. But being above that 200-day moving average, which is at 161.05, and we closed, or Apple closed, at 163.43. That is a really impressive, and it's a big move for Apple, okay? So keep that in mind. Now, mega cap stocks had a slight performance edge over their peers, mainly because of Apple. Apple was definitely a big player in that. But if we look at the Vanguard Mega Cap Growth ETF, ticker symbol MGK, now the weekly expected move that you will see here is the updated one for MGK. I put it here because I was using it today as the mega caps were moving. So the upper end of that weekly expected move is at 207 even, and 195 on the bottom end of that weekly expected move. It jumped over this line that's coming, this trend line that's coming down here. You can see today it jumped that, but this 20-day moving average that is moving like this, that acted as its resistance today. All right, so it wasn't able to close above that 20-day moving average. It's right on it. As a matter of fact, that's at 203 and 203.6, and we closed at 203.8. So it's right there at its 20-day moving average. If the market believes that the CPI report is in favor, or they see it as positive, then this market will continue to rally. And obviously, it'll break this 20-day moving average. If the market sees inflation as coming back, then the market's going to fall. I'm anticipating that for CPI, 8.1%, or am I getting it mixed up? It's either 8.1 or 8.2% is the expectation. I can't believe I'm mixing it up. But the Fed is 0.1% higher than the expectation. The Fed's expectation is 0.1% higher. And now I can't remember if I'm getting it mixed up or not. It might be 8.1% is the expectation. 8.2% is the Fed's expectation. But I did find that discrepancy between what the analysts think CPI will come in at versus what the Fed thinks CPI will come in at. And there's 0.1% difference. Haven't seen that in recent times, where the Fed does not believe inflation is going to come off as quickly as the analysts who believe it will. Will you go over CPI numbers on Discord? Yes. Tomorrow I will post thoughts, the CPI numbers and my thoughts tomorrow morning on Patreon and Discord, both places. So wherever you want to get the information from. I do believe Patreon will send out an email notification when there's a new post. And I believe Discord, as long as you have the app on your phone, it'll send out an actual notification. So yes, to answer your question there, tomorrow morning I will be posting the numbers for CPI and a quick take, the important part, or the important takeaway of the CPI number and what it may mean. So yes, that'll come out tomorrow morning. Of course, after the numbers drop, and they come out again at 8:30 a.m. Eastern. Okay, so yeah, there's the mega cap and their movement. So breaking above this trend line here, they've done it before, but the last time they did it, they pulled right back underneath of it. Again, CPI, that's going to be the big mover of the market tomorrow. And it should either let this rally continue, or it's going to change sentiment and send this market in a different direction. But it all depends on that number. Are we going to get 8.1 or less? I think we rally. 8.1 or less, I do think we rally. 8.1 or higher, and it depends on how much higher, will depend on the strength of the fall tomorrow. So that's the number I'm kind of basing things around. Just to say that one more time, if the year-over-year CPI number is 8.1 or lower, the market will rally, I believe. If the number is 8.1 or higher, then the market will fall. Now, depending on how much higher, 8.2, 8.3, 8.4, the higher it is, or the further it is away from 8.1 on the top side of that number, the faster the market falls. And the same thing can be true on the opposite end of that. The further the number is away from 8.1, like 8, 7.9, 7.8, the faster the market will rally. Okay. I don't think we're going to be too far off from that 8.1, 8.2 area. I think we'll probably be right around that. The danger, I think, will be next month. If oil continues to hold up, if oil continues to rally, that's when I think in October, that reading, we could actually see inflation tick back up. But again, we'll have to watch the data and see what happens. Now, just real quick on this mega cap growth moving, they have been a directional driver all of 2022. You've heard me say that a million times, and it was true today. Since it was moving up, it also helped to pull the broader market up. Even though it outpaced the broader market, it still gave a general positive disposition that left many other stocks higher today. Now, when we look at the sectors, all 11 S&P 500 sectors did close in the green. That wasn't the case earlier today, but it is the case by close of business. So all 11 were in the green, and the gains, they ranged from 0.4% XLP, which is consumer staples, all the way up to 1.8% XLE, which is energy. Now, in our trade setups this morning, we mentioned energy and called out some energy ETFs, just like a XLE, which jumped 1.84% today. Now, let me just put XLE on the screen here. This is the updated weekly expected move. I needed it when trading today. So once that loads, that will be accurate for this week. Now, with XLE jumping today, and about mentioning that on the trade setups, I think more importantly, with what we said many of these charts had a hammer reversal pattern. Now, what's a hammer reversal pattern? I started to bring it up earlier during this live stream. A hammer reversal pattern, or a hammer pattern, it's a price action pattern in candlestick charting that occurs when a security, equity, even crypto, trades significantly lower than its opening. So picture the wick. Oh, I need my highlighter. So picture the wick of a candle, right? Now, where that candle opens, that's where the body of the candle will form. And then as you're trading throughout the day, that candle could drop really low. And then it starts to pull itself back up as you go throughout the day. So it starts to rally towards the close. And as it gets back to the close, it may close slightly down or it may close slightly up. But basically, and let me just fill this little part in right here. But basically, what happens is the candle itself takes the shape of a hammer or mallet. Okay? So you have a long wick on the bottom, and if this is a topping candle, then the wick will be longer on the top. We've talked about this pattern actually several times on many different live streams. So this would be the shape of a hammer candle. Now this pattern, to get it to match the definition of this pattern, the candlestick, which the lower shadow, so the lower wick, and this is on a bottom, right? So the lower wick should be twice the size of the real body of the candle, right? So this area, the wick of the candle right here, this part down to the tip should be twice as big as the candle itself right here, okay? So a 1-to-2 ratio, right? The wick should be twice as long as the body of the candle. And that would get you the official hammer candle, okay? Let me just clean this up a little bit. And then I'm going to open this chart up and show you an example of that hammer candle here. Let me open this up. Oh, can't have the highlighter here. All right, let's pull this down a little bit. Open this up. Okay. So, an example of a hammer candle here. All right. Right here, this candle right here in this oval. It almost, looks like a cross or a sword. That could be seen as a hammer candle. It could be seen as a doji candle as well. So that's an example. And, the underside wick is definitely twice the size of the actual candle, because the actual candle is hardly any wider than, or any higher than the width of an actual candle. So that one's a bit crazy to point out. Another one that you could call a hammer candle is even this one right here, this red one. Okay. The wick comes all the way down to touch that purple line that is the weekly expected move, and then rises back up. So now if you measure this candle, the wick here is about twice as long as the actual candle. Those are hammer candles, and they mark reversals, right? It's when price has been coming down, and I can use XLE here as the example, but it's when price has been coming down, pretty hard, and it overshoots itself and immediately then pulls back up, right? Or even in the opposite direction. If it overshoots itself, it's moving too quickly, and then it pulls right back down. That could leave on the daily candle, that could leave a tall wick on the top of the candle, and hardly any wick on the bottom. So that's typically what happens, and what causes the hammer candle to form. Basically, market participants in their price action, they overshot where they wanted to be. So then they have to pull back to where they should be. Okay? Does that make sense? Just let me know if that makes sense. So I saw a lot of these in the energy space, and that's what led me to call out energy related names for a potential trade setup this morning. And for a lot of them, they worked out wonderful. Like XLE worked out great. Okay, now let me just point this out, and then we'll get moving on, because I just want to make sure that anyone who doesn't know is aware of it. If you would like to get instant access to our weekly expected moves, XLE's weekly expected move is up or down $3.18, numerous trade setups, top 10 stocks, and we just posted the updated top 10 growth stocks list earlier today, and other insights to help you along your investor journey. And just click the first link in the description. Now, Energy, or XLE, had that hammer candlestick. Energy was boosted today by rising energy complex prices. Just look at we'll look at WTI crude oil. We should just type in US oil, USOIL. That'll take you to WTI crude oil. It was up 1.7% today, back up to $87.84 per barrel. It almost closed within that green bar that we have here, but not quite. Now, the wick of the candle did get into that green bar here. It really got super close to that 20-day moving average, and that spooked price action and kept it down a little bit. So that 20-day moving average is at 89.35, and oil is closed at 87.84, both prices per barrel, and currently it's at 88.02 per barrel. So it's gone up some in the after hours. Now, it would not surprise me if oil keeps ticking higher here. Okay? I think I know I told you guys last week when oil was dropping hard and it got all the way down to 81 and some change per barrel, that I was starting to get a little nervous on my thesis about oil prices. Because remember, any idea that you have about an equity or a commodity or a crypto, whatever it is, you should always remain fluid. Update your analysis, update your ideas, update your theses whenever you get new data. So I almost started to at least look into my thesis on the price of oil. But now that we've gotten away from that $81 and some change in oil prices, I'm back to being comfortable with, I do believe oil prices will be higher this winter. And the majority of that is based on Europe's energy crisis. If Europe cannot find enough oil for this winter, that's going to send prices very high. That's my thought. You may have a different thought on this, which is completely okay. Having different opinions, different ideas is wonderful. And sharing those ideas so we can all learn from them is even better. That's the best thing. Okay, so oil didn't quite close within the green box. The wick did get there really close to the 20-day moving average. We may get a little cool off in oil tomorrow because it has been 3 sessions in a row that it's been running. And it typically doesn't run that many sessions in a row this strong. So we could see it pull back tomorrow. Just a little bit or maybe a lot. Who knows? And then we look at natural gas today, and that was up 3.5%. So all of that helped energy rally today. Now, semiconductors. Semiconductors did not do good, or as good. They underperformed. The broader market today, following reports that the White House is expected to tighten restrictions on chip exports to China. Did you really think it would only be NVIDIA affected? Oh no. Oh no, no, no. If the White House truly does this and they put chip exports or restrictions on chip exports to other companies to China that work in China, that sell to China, even just selling to other companies in China, that will hurt their stock price. Okay. So that's why semiconductors underperformed the broader market today. All because of what happened to NVIDIA not that long ago, where the White House put restrictions on the chips that NVIDIA could sell to China. Okay. So if other companies fall under this restriction with their own products, then their price will probably react similar to NVIDIA. Maybe not as bad as NVIDIA, because obviously we have a better understanding of what those restrictions look like when it comes to NVIDIA. So, yeah, Chips Act 2. Yeah, Chips Act 2. All right, so that's why semiconductors underperformed today. Otherwise, semiconductors, they have a lot of things to look forward to in the long term, but there are going to be some short-term headwinds right now with semiconductors. And I don't think I'm alone at all in thinking that semiconductor stocks can and will go lower before we're finally at some sort of a bottom for them. If we go back and look just for this semiconductor ETF, which is the Van Erik Semiconductor ETF, ticker symbol SMH, there was no June low. It was a July low for semiconductors. And let's see, this closed at 217.40, up 0.25%. And the July 5th low was 197. Okay. That's where it closed. Intraday, it got down to 189, but closed at 197. So we're about $20 off from that bottom. Okay. So not too far. All right, let's keep moving on. Let's talk about the Treasury. Let's pull up the 10-year because we had an auction today. US 10Y, that gets you to the 10-year yield. Now, it's been strong. It's been marching straight up and to the right. But today, there was a $32 billion 10-year note auction, and it was met with relatively weak demand. You don't want to see, weak demand. But the high yield of 3.33%, 3.33%, tailed the when issued yield of 3.30%. Now, following the auction, selling pressure picked up in the Treasury market. The 10-year yield, which sat at 3.27% before today's open, settled the session at 3.36%. So almost 0.1% higher, almost. Now, despite the pickup in yield, stocks held their ground. tracking sideways after the initial burst in the morning, but holding the bulk of today's gains. And then the 10-year yield, it too held the bulk of its gains after the auction. Now, the 2-year yield today, it settled down 1 basis point to 3.56%. Wasn't much action at all. But the 10-year, that's where it took place. Now, in after hours, it's down ever so slightly. But if we look at the 10-year, it is quickly approaching this high back here, right? Which was set on January the 14th. I'm sorry, not January. June the 14th. June the 14th. And that high was 3.49%. We're getting close, but we're not there yet. 3.358% is where we're at this exact moment. So it is trucking higher. It has been on a very strong pace. And when you look at the 5-day EMA, whenever it pulls away from it, the very next day, it pulls right back down to it. So today, it pulled off of it, which left us with the 5-day EMA is at 3.327%. So I suspect tomorrow you could see it pull back down to that around that number. Again, that's 3.327. Okay. Now, there was no U.S. economic data of note today, but there were a series of investment conferences that started today involving technology, healthcare, and the financial sector. So we'll keep our eye out for any news there. Now, looking ahead to tomorrow, and tomorrow is going to be a big day for the markets, and I'll talk about the weekly expected moves for the major indices. First, let's start with the SPY. Before I do the weekly expected move for the SPY, let's talk about CPI. Now, we're going to get the August CPI report. The expectation is, I believe it's 8.1%, while the Fed's expectation is actually 8.2%. Again, it's been a while since we've seen this, the consensus and what the Fed believes, what the Fed thinks, not line up. So expectation from analysts is 8.1. The Fed is 8.2. You remember, we got 8.5 last time around, 9.1 the month before that. Okay. So can we continue to come down with CPI on a year-over-year basis? Now, core CPI is expected at 0.3% month over month. And the prior month was also 0.3%. So we keep that going. Now that report is due out at 8:30 a.m. Eastern. 8:30 a.m. Eastern, 1 hour before the market opens. Okay? Very important. It will shape tomorrow's move. Okay? Now, other economic data include the August NFIB small business optimism. How hopeful are small businesses about the economy, about their future? The prior reading was 89.9, which wasn't all that bad. That comes out at 6 a.m. Eastern. So being a small business owner, owning small businesses in the past, I am always curious about this number. So again, 8:30 a.m. Eastern, we get the August CPI report. 8.1 is the analyst expectations. 8.2 is the Fed's expectations. I don't know of any other way to say it other than that. And then we get the NFIB Small Business Optimism Report. Okay. Looking at the weekly expected move for the SPY, the upper end is 416. Okay. The lower end is 396. That's where we're expected. Now, Thursday to Friday and Friday to Monday have left gaps that need to get filled. Okay. There is still on the SPY a huge gap up here around the 420 area. Okay. If the SPY gets up here to fill this gap, then we're looking at the 200-day moving average as the resistance point, and that's at 426. Okay. Now that 416 on the upper end of the weekly expected move, that 416 to 420, that's an important area for the SPY. And the reason for that is there's a lot of trap supply, from here, this area, from this area right here. And it was a very key area during this whole contraction and consolidation back here. All right. So this is a very important area for the SPY, and that's right between 416 and 420. It's at 410, call it 411 right now, okay? So again, 416 to 420, very important. Lots of supply up there that could put a damper on any rally attempt, okay? Let's go look at the Qs. And on the Qs, there's something similar, but not exact. There are gaps that have been created on the way up in this short little bounce that we have seen ourselves in. Now, the weekly expected move on the upper end is 316. The weekly expected move on the lower end is 297. Again, where it's at right now is important if we're looking at this area right here where we consolidated. That's about where we are right now. That kind of is where the 50-day and 20-day moving averages are right now, which aren't too far apart. The 20-day moving average is on the upper side of today's candle at 311, and the 50-day moving average is on the bottom side of today's candle at 307. Okay. So it may find a little bit of resistance here to slow it down so it can't move as quick. And, it all depends on what tomorrow brings. Can this take it up and, go start filling some gaps on the upper end of this? Maybe. But again, it all depends on that data. Okay. Let's go to the IWM, which are the small caps. And again, gaps have been created on the way up with this rally. And actually, I don't have a gap. It's one of the biggest gaps that were left. The gap right here that was created Thursday going into Friday. Oh, went a little too far. But that's a huge gap. That's a huge gap left. It's not exactly precise, but you get my point there. And it's also, kind of tapping out here at that 20-day moving average, which is about 189, and it closed at 189. So the upper end of the weekly expected move for the IWM is 192, and the lower end of the weekly expected move is 181. Now remember, the past 3 weeks, SPY, Q, IWM have all closed outside of the weekly expected move. 2 weeks in a row is pretty astounding. It rarely happens. 3 weeks in a row is nearly a black swan. It just doesn't happen that often. So why could that potentially be happening right now? An options market that is so efficient that it gets it right 68% of the time. Well, this market is so hard to judge what market participants are going to do that the most efficient part of the stock market, the options market, is being inefficient right now. It's that simple. This is a crazy market. Market participants have too much emotion in this bear market, and this bear market is driving this emotion from this bear market. It's driving price action and where the market goes. So the most efficient part of the market is now starting to get it a little bit wrong. It will eventually work out, but at this particular moment in time, it's a bit rough. Okay, if you have any questions, plug them in now. I've gone through all my notes except for one thing. And before I get to that, if you could please do me a favor, click that like button, share this video with a friend. It is a great help to our small channel. And also, if you want our weekly expected moves on 40 different products, our numerous trade setups using many different trading strategies, top 10 stocks in different categories, economic insights, market breakdowns, technical analysis, you name it, to help you along your investor journey, just click the first link in the description, and that'll be wonderful. If you'd like to join the public side of our Discord, click the second link in the description, and that'll take you right to it. Okay, let's see here. Tomorrow, 1 hour before the market opens. Right now, I'm thinking, and this probably goes right into your question here. Do you think a flat CPI report that comes in line would be bearish? I do not. I think if the CPI report comes in flat or better, then I think the market has a good opportunity to move higher. I do. For the market to come down, to pull back from the CPI number, I'm thinking that the inflation number is going to have to be, it's going to have to be higher than what is expected. Okay? So if it's flat to being better than expected, the market will rally. If it is worse than expected, depending on how many degrees of separation worse, then that's going to lead to how fast we fall. But even with where we are right now, like let me go to the SPX just real quick. Let this load. These indicators load. If we look at the RSI, the relative strength, it's a 51. So it's right there at the midpoint, okay? Not oversold, not overbought. The MACD, it's starting to roll over from those negative numbers. The market, even though it has been on a pretty steep, 1% or greater move over the past 3 sessions, there's more left in this rally if CPI is on point, if it is flat, or if the numbers are better. RSI at 50, you know that the last peak in RSI was a 76.5, and that was at the peak of the summer rally. I can put it that way, of the summer rally. Now, remember the two numbers that I talked about at the very beginning, because they are very important. 4260 and 3900. Okay. Bulls need to break the 4260 to say we're in control, to say we're going to take this thing higher. I do not think 4260 will get broke. I think if the market can rally up to this resistance point along the top, this red line, I think it'll be met with the same type of resistance, which was swift. It was hard. It was decisive. That this is resistance. You will not pass. I think that's what the market sees if it rallies to that trend line. On the bear side, though, it's got to have enough momentum to come back down and to break below the 3,900. Otherwise, we're rallying into a wedge. Or maybe we start pulling back after the market goes a little bit higher and then it starts pulling back. We're going into a wedge. Now, with all the indicators on the chart, if the market does have a day of consolidation, a day where it pulls back, it's still technically on the chart set up to continue to rally. So even a small little one-day pullback isn't enough to slow this rally net down if the numbers are in line or better. Okay. All right. One other thing to point out real quick. The seasonality chart. Okay. So it's what history shows us. History says that the second half of September is one of the worst times for the market. Second half of September, historically, looking at a seasonality chart, is the worst or a very hard month for the year. Okay? And I think that even though we're getting a bounce right now, I think from now going into November 1st for mid-election, for our elections, there's going to be a lot of FUD in the market. Let's see here. I have both puts and calls. I might ride one side to 0 in case we get a push-pull move, like the July 9.1 print. Yep. I have got what I think of as a saddle where I'm riding both sides, set up right now. Because it all depends on that number tomorrow. And that number tomorrow, too, it's going to help to dictate what the Fed does. So if that number is in line or better than expected, showing that inflation is coming down, then that's just going to give the Fed more reason to hike rates. And before we sign off, let me just plug in the Fed Watch tool here. Last time I checked, it was even greater than last Friday. I mean, it's getting so close to 100% the last time I checked. Now, let's see where it's at. Let's see. What's it going to look like? A 92? Is that what it's going to give us? This is where, look at that. A 92% probability that on September the 21st, we're going to get a 75 basis rate hike, and we have an 8% chance of a 50 basis point rate hike. Now, a 75 basis point rate hike, with the market rallying from the oversold condition like it is, gapping up this morning, gapping up on Friday morning, is that the market that's pricing in a 75 basis point rate hike? No. No, it's not. So the market is taking it day by day, and they are really trying to be overly optimistic, I think. So we've got that in there to pay attention to. 75 basis point rate hike. That's incredible. Only an 8% for 50. Oh my goodness. It's almost like market participants, do you even pay attention to this tool? Because I know we were oversold, but that should have given us a nice little bounce, but we should have been coming back down now, not continuing to ride. And if I trend line this, I think this is important. If I go from here and if I ride that last high, this lines up with last Friday. Okay? So it kicks off here. It lines up perfectly with actually Jackson Hole right there. And then it lines up perfectly with Friday's high. It does not line up with today's move higher. So today's move higher, that's like we should have got a bounce from being oversold. Okay. That was Friday's close. Sure, there was a little gas left in the tank for today, but that's as far as it should go. In my mind, anyways, being realistic. So this extra move today, and if CPI is right tomorrow, it's going to continue to move up. So, all right. Investor community, I will talk to you tomorrow morning through Discord or Patreon, however you get the information. And everyone else, I will see you tomorrow after the market has closed for another live stream where we talk about what happened, why it happened, and what to expect in the market. So, I caught your question here right at the last second. Jerome didn't want the market to rally, right? What if we got a good CPI print, then he still does the 75 basis point hike? Would we see downside, or do you think the market has priced in a 75? Okay. I do not think the market has priced in a 75 basis point rate hike, nor do I think the market is being rational at this moment in time. This is an irrational market right now. Okay? An irrational market is hard to trade in because it's unpredictable. Yeah, you can use technical analysis to give you clues on which way market should be going, but it doesn't necessarily always work because this market is not thinking rationally. That's my thought on this market. So Jerome Powell does not want this market to rally. When this market rallies, like we have seen over the past 3 to 4 sessions here, I don't know how many it's been. I can't quite see that. 1, 2, 3. Okay. There's 4 green candles. So the past 4 sessions, Jackson Hole, Jerome Powell came out, and that was August 26th. Jerome Powell came out, gave a very hawkish speech saying, market, wake up to reality and stop playing these games. The Fed will not pivot. The Fed is not your friend. Act accordingly. And it's like there's a short-term memory problem. The market tanked and dropped 3.37% is how far the S&P 500 fell that day. And it kept falling for a few more days. But now we get this sharp gap up rally that's trying to take us back to before Jackson Hole. That's not rational. That is not a market playing in reality. That's a market playing in simulation theory or something. I don't know. But Jerome Powell sees a stock market rising and saying, oh my gosh, guys, I tried. But this market doesn't get it. This market doesn't get it. We're trying to fight high inflation over here at the Fed. Our balance sheet, we're taking $95 billion out of the market. We're taking $95 billion of liquidity out of the market every month. We just started it here in February. And yet this market is partying like it's 1999 before the dot-com bubble. not facing reality. That's what this rally is. And Jerome Powell is throwing his hands up and saying, guys, I'm going to have to come out and give the most hawkish speech of my life with the next FOMC meeting on the 21st. With this rally, and if the market continues to rally, Jerome Powell is thinking in his mind, my gosh, Jackson Hole wasn't even scary enough. What I said during Jackson Hole did not scare this market enough. I'm going to have to be even more hawkish on February the 21st to bring this market back to reality. That's my thought. What do you think? I mean, is the market really seeing reality here? You know, the market fell pretty hard after Jackson Hole. And Friday's close, especially today's close, we've now recovered. Not completely, but we are in the recovery phase. We are where we closed today was higher than the Jackson Hole close. Jackson Hole, the S&P or ticker symbol SPX closed at 40.57 and we closed today at 41.10. So we're back above the low from Jackson Hole. Is that reality? No, it's not. No. All right. Anything else that you'd like to discuss? Otherwise, we can wrap it up here. Just please remember to click that like button. That definitely helps. And again, if you want our trade setups, if you want our weekly expected moves, top 10 stocks, market insights, click the first link in the description. I know you'll love it. I know you would. Okay. Well, if that's it, yeah, this market can be tough. Yeah, absolutely, it can be. It is definitely not getting what Jerome Powell said at Jackson Hole. It's got a short-term memory problem, and it cannot remember Jackson Hole. Okay, well, I will wrap it up here. Okay. You are welcome. Absolutely. All right. I'll wrap it up here. Again, investor community, I will be posting on Patreon and on Discord tomorrow morning. And I will see you all tomorrow after the market closes. Let's see what type of ride we're going to get tomorrow. It should be fun. Definitely. And it'll definitely be choppy. I can see that. Okay, I'll stop rambling here and we'll wrap it up. So have a wonderful evening. I'll see you tomorrow. And thank you for watching. I appreciate each and every one of you. Have a good night.